$1.5 trillion is the specific number that is currently haunting every Federal Reserve official behind closed doors. It is not the national debt, it is not consumer credit cards, and it is not the auto loan bubble. It is a massive, immovable wall of commercial real estate debt that is legally set to mature in the first quarter of 2026. We are standing on the precipice of the largest destruction of real estate wealth since the Great Depression of the 1930s. For the last 2 years, the mainstream financial media has largely ignored this massive financial threat, hoping that interest rates would fall in time. They told you that the soft landing was achieved, and that the banking crisis of 2023 was just a singular, isolated event. But the mathematics of the bond market do not care about political narratives or optimistic morning talk show segments. The math says that thousands of office towers, shopping malls, and apartment complexes are technically insolvent at today's interest rates. These buildings were purchased with cheap debt when rates were near zero, but now that debt is officially coming due, they must refinance that debt at rates that are 300 to 400% higher than their original loans. The rental income from these properties does not cover the new mortgage payments, creating a negative equity death spiral. This is not a theoretical future problem. The default notices are already being printed and sent out to landlords across America. We are witnessing the end of the extend and pretend era, where banks allowed borrowers to mask their true solvency. The regulators have stepped in and demanded that banks mark these assets to their true market value immediately. And the true market value of a downtown office tower in San Francisco or Chicago is significantly lower than the loan amount. Before we expose the specific banks that are most at risk of failing from this wave, I need you to join us. Please subscribe to the channel right now and turn on notifications, because this story is moving faster than the news can report. And leave a comment below with the name of your local bank so we can help you research their exposure to this crisis. To understand why this crash is inevitable, you have to look at the structure of the loans themselves. Commercial real estate loans are not like your 30-year fixed-rate residential mortgage that is safe from inflation. They are typically 5-year or 10-year balloon loans, meaning the entire principal balance must be paid back or refinanced at the end of the term. In 2021, trillions of dollars were lent out at rock-bottom rates of 3% to optimistic developers. Those 5-year loans are hitting their maturity date right now, in 2026, in a completely different interest rate environment. To refinance today, those developers need to pay 7 or 8% interest, which doubles their monthly debt service payment. But while their costs have doubled, their income has collapsed due to the permanent shift to remote work. Vacancy rates in major metropolitan areas have stubbornly remained above 20% for 3 consecutive years. This creates a severe cash flow crisis, where expenses are skyrocketing while revenue is plummeting through the floor. No bank in their right mind will refinance a building that is losing money every single month, so the borrower has only one choice: hand the keys back to the bank and walk away from the property. This is exactly what we are seeing with major players like Brookfield and Blackstone, who are strategically defaulting on billions. If the largest, most sophisticated real estate investors in the world are walking away, what happens to the small landlords? They get crushed, and their collateral gets liquidated at fire sale prices that destroy the comparable values for everyone else. But the real victim in this story is not the landlord. It is the bank that lent them the money. And this is where the crisis shifts from a real estate issue to a banking system collapse overnight. The entities holding these toxic loans are not the giant too-big-to-fail banks like JP Morgan or Chase. The giants saw this coming years ago and quietly offloaded their exposure to smaller, hungrier institutions. The bag holders are the small and regional banks that form the backbone of the American small business economy. Data from the FDIC confirms that regional banks hold nearly 70% of all commercial real estate debt in the United States. These are the banks where you have your savings account, your business payroll, and your safe deposit box. They loaded up on these loans because they offered slightly higher yields than treasury bonds during the low-rate years. Now, those loans are turning into non-performing assets that are eating a hole in their capital reserves. We are looking at a scenario that is mathematically identical to the savings and loan crisis of the 1980s. In that crisis, over 1,000 banks failed because they held long-term loans that lost value when rates rose. Today, we have over 4,000 regional banks, and hundreds of them are technically insolvent right now. They are zombie banks, operating only because they have not yet been forced to recognize their losses on paper. But the Q1 2026 maturity wall is forcing that recognition, whether they like it or not. When a borrower defaults, the bank effectively becomes the owner of an empty, decaying office building. Banks are not property managers. They do not know how to fix elevators or negotiate leases with tenants. They are forced to sell the asset immediately to raise cash, usually at a massive discount to the loan value. If a bank lent $100 million on a building that sells for $50 million, they take a $50 million loss. If that loss exceeds the bank's capital buffer, the bank fails instantly and is seized by the FDIC. This is the mechanism of contagion. One default lowers property values, which causes more defaults, which bankrupts the banks. The Federal Reserve knows this, which is why they are frantically trying to create new lending facilities behind the scenes. But you cannot lend your way out of a solvency crisis. You can only print your way out, which causes inflation. This leaves the Fed trapped between allowing a deflationary banking collapse or triggering hyperinflation to save the landlords. The market is starting to sniff out this fear, which is why bank stocks have been under heavy pressure all week. Short sellers are circling the regional banking ETF, looking for the next domino to fall in this chain reaction. They are looking at the office sector specifically, which has become the subprime mortgage of 2026. The valuations of Class B and Class C office buildings have fallen by nearly 60% in real terms. These are the older buildings in downtown corridors that are not environmentally friendly and lack modern amenities. Tenants are fleeing these buildings in a flight to quality, moving to newer, smaller spaces that are better located. This leaves the older buildings completely empty, creating ghost towers in the center of our major cities. You can see this with your own eyes if you walk through downtown San Francisco, St. Louis, or Baltimore today. Boarded up storefronts and empty lobbies are the visible symptoms of a financial cancer that is spreading unseen. But the cancer is not just in office buildings, it is spreading into the multifamily apartment sector as well. During the boom of 2021, syndicators bought thousands of apartment complexes using aggressive floating rate bridge debt. They assumed they could raise rents by 20% every year forever to pay for the rising interest costs. But rent growth has stalled as the economy slows down, leaving these syndicators unable to pay their debts. We are about to see a wave of foreclosures on apartment complexes that will rival the housing crash of 2008. This will not necessarily lower your rent, but it will destroy the capital of the investors who funded these deals. Pension funds, insurance companies, and private equity firms are heavily exposed to this multifamily collapse. Your retirement money might be invested in a real estate income fund that is currently marking its assets to fantasy levels. When the mark-to-market reality hits, those funds will gate withdrawals and lock your money inside the burning building. We saw this happen with the Blackstone Bright fund in previous years, and that was just a tremor before the earthquake. The liquidity mismatch is the core problem. Funds promise daily liquidity while holding assets that take years to sell. When everyone rushes for the exit at the same time, the door is too small and the structure collapses. This is why we warn you to know exactly what is in your portfolio and who holds the counterparty risk. If your wealth is tied to the valuation of commercial real estate, you are standing on a fault line. The appraisal gap is the dirty secret of the industry that no one wants to talk about openly. Appraisers are being pressured to keep valuations high to prevent the banks from breaching their capital requirements. But true price discovery only happens when a transaction occurs. The transaction volume has dried up completely. Sellers refuse to sell at the new low prices, and buyers refuse to buy at the old high prices. This standoff has frozen the market for 18 months, but the debt maturity is the catalyst that breaks the ice. You cannot refuse to sell when the loan is due and you do not have the cash to pay it off. Forced selling is the ultimate price discovery mechanism, and it is brutally honest about the destruction of value. We are already seeing keys for cash deals where lenders pay borrowers to walk away quietly without a fight. But there is not enough cash in the system to pay everyone to walk away from a $1 trillion problem. The sheer scale of the $1.5 trillion wall is too large for the government to bail out without consequences. If they bail out the commercial landlords, the public outrage will be deafening and politically suicidal. If they let them fail, the banking system grinds to a halt and credit stops flowing to the real economy. This creates a credit crunch where small businesses cannot get loans to buy inventory or make payroll. This is how a financial crisis on Wall Street becomes a Main Street recession that costs you your job. The transmission mechanism is the local bank that suddenly stops answering the phone because they are fighting for survival. We are already seeing credit standards tighten to the highest level since the COVID crash of 2020. Banks are hoarding cash, refusing to lend, and preparing for the storm that they know is making landfall. The loan loss provisions at major regional banks have skyrocketed in the last quarterly earnings reports. This is the accounting equivalent of boarding up the windows before a hurricane hits the coast. They know the default wave is coming, and they are trying to build a fortress balance sheet to survive it. But for many of them, it is simply too little, too late to fill the hole in the hull. The leverage ratios are too high, and the asset quality is too low to withstand the incoming flood. We are watching a slow-motion train wreck that has been accelerating for 2 years and is now impact imminent. The crash will not be linear, it will be exponential, with one failure triggering the next in rapid succession. It will start with a few headlines about a developer defaulting, then a regional bank failing, then panic. We are currently in the headlines phase, but the panic phase is the next logical step in the sequence. The commercial real estate apocalypse is not a prediction. It is a mathematical certainty based on signed contracts. The contracts say the money is due, and the balance sheets say the money is not there. This simple equation sums up the entirety of the crisis we are facing in the first quarter of 2026. There's no magic wand that can erase debt or fill empty office buildings with paying tenants overnight. There's only the hard reality of deleveraging, which is a fancy word for losing money and going broke. You need to be prepared for the fallout, which will affect everything from stock prices to local property taxes. When commercial values crash, the tax base of cities collapses, forcing them to cut services or raise your taxes. This is the secondary shockwave that hits your wallet even if you do not own a single commercial building. The interconnected nature of our economy means there are no safe harbors when $1 trillion evaporates. But knowledge is power, and understanding the timing of this wave gives you a massive advantage over the herd. Most people will be blindsided when their bank fails or their local downtown becomes a ghost town. You will know exactly why it is happening and who is responsible for the destruction of capital. The distinction between winners and losers in this new economic reality will not be determined by luck, but by liquidity. Those who have cash will be able to buy premier assets for pennies on the dollar, while those trapped in illiquid structures will face total ruin. This is where the crisis shifts from the visible banking sector to the opaque and terrifying world of shadow banking. For the last decade, as regulators tightened the screws on traditional banks, a massive amount of lending moved into the shadows. Private credit funds, unregulated by the Federal Reserve, stepped in to fill the void, lending hundreds of billions to risky projects. These funds operate in a black box, valuing their own assets using internal models rather than open market prices. They have reported steady, unwavering returns for years, creating an illusion of stability that defies market gravity. But the $1.5 trillion maturity wall is the moment where these internal valuations collide with external reality. When a private credit fund forces a borrower to liquidate a property, the sale price becomes public record. That single data point acts like a contagion, forcing every other fund to mark down their similar assets to that new low price. This triggers margin calls from the big banks that lent money to the private credit funds to juice their returns. We are staring at a leverage on leverage, unwinding that mimics the subprime crisis, but with office towers instead of suburban homes. The systemic risk is actually higher this time because the entities holding the bag are not just banks, but pension funds. Your state pension plan likely allocated billions to alternative investments, like private real estate, to chase yield. They were sold a lie that these assets were immune to stock market volatility and provided safe, steady income. Now, those assets are liquid, frozen, and rapidly depreciating, leaving a massive hole in the pension's funding status. If public pensions cannot pay retirees, the taxpayer is legally on the hook to make up the difference. This is how a commercial real estate crash in New York or Chicago ends up raising property taxes in the suburbs. The urban doom loop is the sociological phenomenon that accelerates this financial collapse into a civic nightmare. As office values crater, the property tax revenue that cities rely on to fund police, fire, and sanitation evaporates. A recent study estimated that New York City alone could lose billions in annual tax revenue due to the office apocalypse. To close the budget gap, the city must either raise taxes on residents or slash essential public services drastically. If they raise taxes, wealthy residents flee to low-tax states, further reducing their revenue base and worsening the deficit. If they cut services, crime rises and the streets become dirty, causing even more businesses and residents to leave. This self-reinforcing downward spiral turns vibrant metropolises into hollowed-out shells within a span of a few years. We are already seeing the early stages of this in cities like San Francisco, where the tax base has been decimated. The return-to-office mandates were a desperate attempt by mayors and CEOs to stop this bleeding, but they failed. Workers refused to come back, and now the leases are expiring, revealing the true extent of the vacancy crisis. This leads us to the most dangerous aspect of the entire situation, the illusion of FDIC insurance protection. Most Americans believe that if their bank fails, the government will simply write them a check for their deposits. But the FDIC Deposit Insurance Fund has nowhere near enough capital to cover a systemic collapse of regional banks. The fund holds roughly $120 billion to insure trillions of dollars in deposits across the system. That is a reserve ratio of roughly 1.3%, which works fine for isolated bank failures, but it does not work when 50 or 100 banks fail simultaneously due to a correlated asset crash. In a systemic crisis, the FDIC would be insolvent within days, forcing Congress to authorize a taxpayer bailout. But the political appetite for bailing out banks in 2026 is non-existent compared to 2008. This is why you need to understand the bail-in laws that were passed under the Dodd-Frank Act. These laws legally allow a failing bank to convert your deposits into equity to recapitalize the institution. Instead of getting your money back, you could wake up one morning owning shares in a bankrupt bank. This is not a conspiracy theory, it is the law of the land designed to prevent future taxpayer bailouts. They call it a bail-in because the money comes from inside the bank, from the depositors and bondholders. This mechanism has already been used in Europe during the Cyprus banking crisis, and it is in the US playbook. If you have more than $250,000 in a single bank, you are an unsecured creditor. And in a commercial real estate collapse, unsecured creditors are the last people to get paid. This is why Treasury direct accounts and diversified custody are essential survival strategies for this specific environment. You must remove your counterparty risk from the entities that are holding the toxic real estate paper. But the contagion does not stop at the banks. It spreads to the insurance industry as well. Life insurance companies are massive holders of commercial mortgages, using them to back their annuity payouts. If those mortgages default, the solvency of the insurance companies comes into question immediately. We could see a scenario where safe annuity payments are slashed or frozen due to investment losses. The entire financial architecture of the last 40 years was built on the assumption that real estate only goes up. That assumption has been proven false, and the structural integrity of the system is failing. The derivatives market is the final layer of this house of cards, and it is the most opaque. Banks use interest rate swaps to hedge their exposure, creating a web of interdependencies that no one understands. If one counterparty fails to honor a swap contract, it can trigger a chain reaction of defaults globally. This is exactly what happened with long-term capital management in 1998, requiring a Fed-orchestrated rescue. But the size of the derivatives market today is orders of magnitude larger than it was back then. The notional value of these contracts is in the quadrillions, a number that exceeds global GDP. Even a small dislocation in this market can wipe out the capital of the largest global banks instantly. The $1.5 trillion commercial real estate loss is the spark that could ignite this derivatives powder keg. This is why the Federal Reserve is trapped. They cannot let rates rise, but they cannot let inflation rage. They are trying to thread a needle while riding a unicycle on a tightrope during a hurricane. The Bank Term Funding Program was a temporary patch, but it expired, leaving banks exposed again. Now they are inventing new acronyms and new facilities to try and hide the losses from the public. But you cannot hide a skyscraper that is sitting empty in the middle of Manhattan or Chicago. You cannot hide the fact that the landlord has stopped paying the mortgage and the lights are out. Real estate is a tangible asset, and its failure is visible to anyone who walks down the street. The extend and pretend game worked when money was cheap, but it dies when money is expensive. We are entering the find out phase of economic history, and the lesson will be painful. The transfer of wealth from the oblivious to the prepared is accelerating with every passing day. Institutional investors are already positioning themselves for the distress, raising billions in vulture funds. These funds are waiting for the banks to capitulate so they can buy Main Street assets for pennies. They want to turn America into a nation of renters, owning the land and the buildings you live in. By crashing the small banks, they eliminate the competition and consolidate control into fewer hands. This consolidation is not an accident. It is a feature of the system during every major crisis. The big eat the small, and the central bank facilitates the meal by providing the liquidity. You must ensure that you are not on the menu when the feast begins in earnest. Diversification into assets that are not liability matched to the banking system is your only defense. Physical assets, sovereign debt held directly, and productive land are the only true safe havens. The paper wealth in your brokerage account is just a digital entry that relies on a functioning grid. If the grid of financial trust breaks, those digits become inaccessible or worthless overnight. We saw this in Lebanon, we saw this in Greece, and we are seeing the cracks form here. The commercial real estate crisis is the crack in the dam that everyone is trying to ignore. But the water is seeping through and the pressure is building with every maturity date that passes. The month of March is historically a turning point for financial liquidity, and this March is critical. A massive tranche of commercial mortgage-backed securities is set to reprice in the next 30 days. If those securities fail to refinance, the rating agencies will be forced to downgrade the entire sector. A downgrade to junk status forces pension funds to sell mandated assets, triggering a liquidity cascade. This forced selling is the mechanism that takes a slow burn and turns it into a forest fire. The fire sale prices will shock the market and reveal the true depth of the insolvency. We are watching the clock tick down on a legacy of debt that can never be repaid. It can only be defaulted on or inflated away by destroying the value of the currency. The Fed will eventually choose inflation, but not before the deflationary crash wipes out the leverage. You must survive the crash to benefit from the inflation that comes after the rescue. Survival requires liquidity, zero debt, and a skeptical eye toward official banking narratives. The next phase of this crisis involves the specific legal triggers in the CMBS contracts. These contracts have special servicers who take control of the property when a loan defaults. The special servicer's only job is to liquidate the asset as fast as possible to recover cash. They do not care about the fair value or the long-term potential of the building. They hit the bid, creating a new floor price that destroys the equity of every neighbor. This aggressive liquidation cycle is about to begin, and it will be ruthless and fast. The ruthlessness of the special servicer is the catalyst that turns a slow market correction into a violent market crash. They are the executioners of the real estate world, and they have no loyalty to the borrower or the local community. Their mandate is strictly legal and financial. Recover as much principal as possible, as quickly as possible, for the bondholders. When they dump a premier office tower onto the market for 40 cents on the dollar, it sets a new comparable sale. This new comp is the data point that every other appraiser in the city is legally required to use for valuation. Instantly, every building within a 10-mile radius is devalued by 60% on paper, regardless of its occupancy. This triggers immediate loan-to-value covenant breaches for hundreds of other borrowers who were technically paying their bills. Banks are then forced to call these performing loans because the collateral value has fallen below the regulatory safety threshold. This creates a doom loop, where forced selling lowers prices, which triggers more forced selling, which lowers prices further. We are currently standing at the very top of this spiral, looking down into the abyss of price discovery. The $1.5 trillion figure represents the initial wave, but the secondary waves will be driven by this covenant contagion. It is a mathematical chain reaction that cannot be stopped once the first major domino has been tipped over. The Federal Reserve is acutely aware of this dynamic, which is why they are hesitant to lower interest rates too quickly. If they cut rates to save the real estate market, they risk reigniting the inflation that they spent 3 years fighting. But if they keep rates high, they guarantee the destruction of the regional banking system and the commercial property market. They are caught in a checkmate scenario where every move leads to a disastrous outcome for a different sector. This paralysis at the central bank leaves the market to sort itself out through the brutal mechanism of bankruptcy. We are about to see a historic surge in Chapter 11 filings, not just from developers, but from the businesses that serve them. Construction companies, architects, interior designers, and furniture suppliers are all about to hit a massive wall of non-payment. When a developer goes bust, the general contractor does not get paid, and the subcontractors do not get paid. This creates a wave of unemployment in the skilled trades that will rival the housing bust of 2008. The labor hoarding that companies engaged in during the labor shortage is flipping into aggressive labor shedding. Unemployment is the final lagging indicator that confirms the recession has arrived, and the data is starting to turn. As jobs vanish, the consumer pulls back on spending, which further hurts the retail tenants in these commercial properties. Shopping malls and strip centers, which were already struggling, will face a new wave of store closures and lease defaults. This is the holistic nature of the crisis. It is not just about empty offices, it is about the entire economic ecosystem. The small business owner is the one who ultimately pays the price for the speculation of the Wall Street giants. When the local regional bank takes a massive loss on an office tower, they stop lending to the local bakery or mechanic. This credit crunch strangles the real economy, making it impossible for small businesses to expand or hire. We are seeing a consolidation of power where only the massive corporations with access to bond markets can survive. This Walmartization of the economy accelerates during every credit cycle, wiping out the middle class of American business. You must position yourself to be independent of this credit cycle, operating with cash and tangible assets. The illusion of wealth created by cheap debt is evaporating, revealing who is swimming naked as the tide goes out. But amidst this destruction, there's a massive opportunity for those who have kept their powder dry. The Great Wealth Transfer is not just a catchy headline, it is the literal mechanism of depression or recession. Assets are not destroyed. They are transferred from the indebted hands to the solvent hands at a discount. We are entering a buyer's market of generational proportions, but only for those who have the liquidity to act. Cash is currently king, giving you the optionality to swoop in when the panic reaches its absolute peak. The vulture investors are already raising capital, preparing to buy Main Street America for pennies on the dollar. You do not have to be a billionaire to participate in this, but you do have to be patient and disciplined. You must resist the urge to buy the first dip, because the first dip is often just the beginning of the slide. Wait for the capitulation. The moment when the news is so bad that everyone else is terrified to touch the asset class. That is the moment of maximum opportunity, the moment where fortunes are made that last for generations. But to get there, you must navigate the psychological warfare that is being waged by the media and the banks. They will try to gaslight you into believing that everything is fine right up until the moment the doors close. They will tell you that the banking system is sound and resilient, while they are arranging emergency mergers on weekends. We saw this with Silicon Valley Bank. We saw this with First Republic. We will see it again this year. Do not listen to what they say. Watch what they do with their own money and their own balance sheets. The insiders are selling, the CEOs are dumping stock, and the smart money is moving into hard assets. They are building their lifeboats while telling you to stay on the ship and enjoy the buffet. You must build your own lifeboat, constructed of financial literacy, diversified assets, and zero consumer debt. The commercial real estate crash is the iceberg, and the U.S. economy is the Titanic steaming towards it at full speed. The collision is inevitable because the turning radius of a $28 trillion economy is simply too large. We are going to hit the wall, and the impact will reshape the financial landscape for the next 20 years. The work-from-home revolution was the structural shift that exposed the financial leverage, but the debt is the explosive. Technological obsolescence has rendered billions of square feet of office space useless in the modern digital economy. We are trying to finance a 20th century physical infrastructure with a 21st century digital revenue model. The math does not work, and the market is finally forcing the correction that should have happened years ago. This correction will be painful, it will be messy, and it will be political dynamite in an election cycle. Politicians will scramble to blame everyone but themselves, proposing price controls and subsidies that will fail. They will try to ban foreclosures or freeze rents, measures that only prolong the pain and destroy more supply. Government intervention is the wild card that can turn a deflationary crash into an inflationary depression. If they print trillions to bail out the landlords, the dollar will lose value faster than the real estate loses value. This is the Argentinian scenario, where the stock market goes up in nominal terms, but buys you less bread. You must prepare for both outcomes, the deflationary shock of the crash and the inflationary response of the rescue. Owning fixed-rate debt, like a mortgage, is a hedge against inflation. Owning cash is a hedge against deflation. Owning gold and silver is a hedge against the chaos and the loss of confidence in the system itself. Diversification is not just a buzzword, it is a survival strategy for a binary outcome world. We do not know exactly which path the government will choose, but we know they will choose the path of least resistance. And historically, the path of least resistance is always to print money and to value the currency to hide the debt. The $1.5 trillion commercial real estate hole will likely be filled with newly printed fiat currency eventually. But before that flood of money arrives, the drought of liquidity will kill the unprepared. You must survive the drought to swim in the flood, and that requires prudence and foresight right now. Do not overextend yourself buying toys or liabilities when you should be stockpiling resources and capital. The consumer mindset is your enemy in this environment. You must adopt the investor mindset immediately. Every dollar you spend on nonsense is a dollar you cannot use to buy a distressed asset later. The discipline you exercise today will determine the level of freedom you enjoy tomorrow. We are witnessing the end of an era of easy money, the beginning of an era of hard choices. The default wave is the mechanism that forces these choices upon us, individually and collectively. It forces the bank to choose between solvency and loyalty. It forces the city to choose between taxes and services. And it forces you to choose between being a victim of the system or a master of your own destiny. The information we have shared in this series is your map through the minefield that lies ahead. It is not a prophecy of doom, but a blueprint for survival and ultimate prosperity in a changing world. The commercial real estate apocalypse is real. It is happening, and it is accelerating. But for the educated, the prepared, and the brave, it is the greatest opportunity of our lifetimes. Stay focused on the data, ignore the noise, and trust your own eyes over the talking heads on television. Walk through your downtown, look at the for lease signs, and realize that the market is speaking to you loudly. It is telling you that the old world is dying and a new world is being born from the ashes of bad debt. We will be here every step of the way, analyzing the filings, tracking the failures, and identifying the opportunities. This is not the end of the story, it is just the end of the beginning of the Great Reset. Thank you for watching this deep dive into the financial crisis that is shaping our future. If you found value in this analysis, please hit the like button to help us beat the algorithm and warn others. Make sure you are subscribed to the channel with the notification bell turned on so you never miss an update, and leave a comment below telling us where you are watching from and what you are seeing in your local real estate market. Your boots on the ground reports are invaluable to this community and help us piece together the puzzle. Stay safe, stay liquid, and keep your eyes open because the next shoe is about to drop. We will see you in the next video.